Hello and welcome to Capital Market. I'm Chimeze Obi Iwagwo. This week saw profit-taking activities intensify in the equities market as the sell-offs from the previous week persisted. With losses recorded on 3 of 5 trading sessions of the week, the all-share index shed 1.19% to settle the year-to-date loss at 15.6%. Now, analyzing the performance by sectors similar to last week, significant losses recorded in the banking and industrial goods sectors weighed on the market performance as both indices declined by 1.2% apiece. The consumer goods index followed suit, declining by 0.5%. On the other hand, trading in the insurance and oil and gas indices were sideways as both indices closed flat. Analysts at Codrus Capital are of the view that given the risk of sentiment dominating the domestic market, the market is expected to shed points in the coming week, except there is policy-driven catalyst. Nonetheless, according to them, valuations remain attractive and so expect pockets of gains over the final weeks of the year as fund and portfolio managers realign portfolios prior to the start of 2020. Okay, let's look at what made news in the market during the week. Eland and Seplat have announced that their scheme of arrangement has been sanctioned by the court. The scheme will become effective upon the court order being delivered to the Registrar of Companies, which is expected to take place on December 17, 2019. It will be recorded that on the 15th of October 2019, the boards of Eland and Seplat announced that they had reached agreement on the terms of a recommended cash acquisition by Seplat of the entire issued and to be issued ordinary share capital of Eland. The acquisition is to be implemented by means of a scheme of arrangement under Part 26 of the Companies Act 2006, which requires the approval of the scheme shareholders and the sanction of the court. Dealings in Eland shares will be suspended with effect from close of business on 16th of December 2019. Accordingly, 16th of December 2019 will be the last day of dealings in and registration of transfers of Eland shares. And CNI Leasing PLC during the week notified its shareholders, the Nigerian Stock Exchange and the general public that the board of the company has been duly informed of a likely financial error in the audited accounts of its Ghana subsidiary, Leasafrique Ghana Limited. Leasafrique is a non-bank financial institution incorporated in Ghana in 1992 to carry on the business of finance leasing as its principal business. CNI Leasing PLC, a group of companies involved in the business of fleet management, outsourcing and marine services and listed on the Nigerian Stock Exchange, owns 71% equity stake in Leasafrique, and the subsidiary contributes about 10% to the group's financial performance. And the CEO of the Nigerian Stock Exchange, Mr. Oscar Onyema, has raised concerns about the insurance sector's low contribution to the gross domestic product. Mr. Onyema, who spoke during the NSE Insurance Sector Forum in Lagos during the week, describes the insurance sector as an important part of the economy that is too significant to be neglected.
According to the National Bureau of Statistics, the insurance sector recorded a nominal growth rate of 6.69% and a real GDP growth rate of 3.96% in Q3 2019 from 4.48% in Q2 2019 and 1.03% in Q3 2018. Although this data indicates a positive outlook in the Nigerian insurance industry, the reality and headwinds faced by operators in the sector are quite formidable. Many licensed insurers are largely undercapitalized, thus limiting their ability to take on big-ticket in-country risks, as is often required in the oil and gas, marine and aviation sectors. As at Q3 2019, the insurance sector contributed less than 1% to the GDP of Nigeria, having a penetration rate of 0.31% and an insurance density of 6.2%. The Nigerian insurance industry still lags behind its African counterparts, with South Africa having a penetration rate of 14.7%, Kenya 2.8%, Ghana 1.1%, and Egypt 0.6%.
Oscar Onyema, CEO of the Nigerian Stock Exchange. In the meantime, at that insurance sector event, the head of research, Coronation Asset Management, spoke on global and domestic insurance landscape, implications of the new minimum paid-up share capital requirements to operators, and recapitalization options available through the capital market. Let's take a listen.
Globally, you're looking at a sort of insurance penetration level of around 8% to 9%. Now this is, insurance penetration is very easy. You take the total gross premiums written in any one market and you compare it with a nominal GDP. And so this is what this chart does. And other markets like India, which have a similar GDP per capita to us, have penetration of around 3 to 4%. In India's case, it's 3.69%. Kenya has 2.37%. Nigeria has insurance penetration of 0.31%. It is subscale by a factor 10. So why do we put that chart next to the one about the capital requirements? Because, in my view, there's no need to be anxious about the level of capital requirement. Yes, it's a lot of money, but if you believe that the Nigerian insurance industry can grow to its potential, i.e. rise by a factor 10, what you're paying in equity to recapitalize your companies is option money. It's pin money. It's small money. I was talking with a panelist earlier this morning. He said, why does nobody complain about the level of recapitalization required, given that, for example, a non-life insurer is asked to go from a capital requirement to 3 billion to 10? The answer's there. The potential is so huge that really it is worth paying that money to stay in the game. So now I'm going to explain what that potential is all about. So, in nominal terms, it looks like the industry is growing. But in fact, you do a simple inflation adjustment and you find out that it isn't. So inflation this year is about 11%. If you inflation adjust, you will find that the industry is not growing that much. And if you look over a long period of time, say 10 years, there's really been no growth at all in the whole of the Nigerian insurance industry over 10 years. If you take total premiums together, they grew at a compound annual growth rate of 1.4%. Now, I said no growth. That is growth, but it's very low. 1.4% is a very low growth rate in real terms. So you have to ask yourself, how did that happen? And how can we stop that from happening in future, given that you're going to recapitalize your companies? A similar things happens if we translate the gross premiums of the Nigerian insurance industry into dollars for each year. If we do that, again, we find there's almost no growth. The compound annual growth rate over 10 years is about 0.3%. Very, very low. So in essence, you're flatlining in growth over a long period of time. Now that's why we get to our title, From the Lagoon to the Ocean. We're all aware of the lagoon, it's right behind me. It's a body of fairly stagnant water. It's pretty slow moving, and I believe it's silting up fairly quickly. Out there is the ocean, and the big animals need to get from the lagoon to the ocean, and I believe that can be done, and we're going to explain how other countries have managed to do that. But at the same time, and while I'm being perhaps critical of the industry for its lack of growth over a long period of time, or at least a decade, That's not true of other parts of the Nigerian financial services industry. Other parts of the financial services industry have done very well, and I'm going to start with the pension funds. The pension funds have done really well. Over a period of 10 years, the inflation-adjusted assets under management of the pension funds have grown by just under 10% in inflation-adjusted terms over 10 years. Now, if you're in a business that is growing that fast, you're happy. If you're not in that business, you probably want to be in that business. 10% growth in real terms is magnificent. That would mean that in a year like this, your top line is growing in nominal terms by 20, 22%, something like that. You certainly want to be in a business like that. And pension funds have been there. And fortunes have been made in the pension fund industry. And fortunes, I believe, will continue to be made there. Now, it's important to dig into that detail just a little bit and see that everything has been going okay. Because, of course, it could be the case that there are just one or two people with huge pension funds, in which case the point of the industry would be rather lost on us. But that's not the case. This chart here, you may not be able to see quite the detail, but from the beginning of 2014, the number of Nigerians with retirement savings accounts rose from 6 million to about 8.6 million now. So that's a social function. It's now performing a social function, and it's becoming a numbers game. How many people can you get into the RSAs is the key question, and it's been answered positively. Take-up of retirement savings accounts has gone from early 2014, about 3.5%, to around 4.3% now. Now, 4.3% I think is a very interesting percentage because if you look at a market like India and you ask that market, what's your level insurance penetration, the answer is 3.69%. So getting to sort of over 3.5%, 4% insurance penetration is not impossible. The pension fund industry has shown us how that can be done. And as well as that, this typically happens where you have a nice, strong pension fund industry, which, let's face it, is actually compulsory upon people in employment. You also get a voluntary reaction too, a positive voluntary reaction happening too. And so the mutual funds have taken off. Now, part of that, you can probably guess it from the chart I'm presenting here, is the fact we've had very high interest rates in 2017, 2018, and on into 2019. So therefore, people have put their money into money market funds. But you can't deny the fact that if you're in an industry with a compound annual growth rate of around, well, in excess of 20%, and that's inflation adjusted, that sure is an industry that you would like to be in, I'm sure. Okay, so we're now going to draw a comparison with, and this was mentioned in the text that the Nigerian Stock Exchange prepared for us this morning, between the insurance industry and the banking industry. The banking industry had many of these same problems that the insurance industry had before the reforms of Professor Charles Saludo in 2004. Low growth, low numbers of customers, crucially, and in general a sort of an apathetic attitude on the part of the public towards banks. Now, what the then governor of the Central Bank of Nigeria did was demand steep capital increases from the banks. And he succeeded in reducing the number of banks acting in the country from 89 to 25. What happened to the size of the banking sector after that? The answer is it took off like a shot. From 2005, what's that, 2004 to 2009, the gross customer loans of the banks, again, in inflation-adjusted terms, took off at a compound annual growth rate of nearly 28%. This reform in 2004 transformed the banking industry. And it brought in millions of customers, as we're going to see at the end of the presentation. It brought in millions of customers. And I believe that, properly conducted, the insurance reform will bring you millions of customers.
We'll talk more on insurance recapitalization after the break. Just stay with us. Insurance companies have until June next year to recapitalize, and it is believed the recapitalization will bring an inflow of about 200 billion naira capital into the insurance sector. Let's hear from an investment analyst point of view. I'm being joined by Robert Omotunde. Good evening, Robert. Thank you for joining us. All right, Guy, the person that spoke at that insurance sector says if the banking sector can do it, the insurance sector can as well do it. They have 6 months to go. Can they do it?
I mean, absolutely. I mean, there are things that can be done. The tier-based solvency capital that has been rolled out by NICOM is meant to get all the insurance companies. I mean, there's a tier-based recapitalization.
In other words, there's nothing like, well, they're not going to have anything like mergers and acquisition.
Well, there may be mergers or acquisition. I mean, but the way it's been structured by NICOM, I mean, NICOM has the intention not to take out any insurance company out of business. So insurance companies who are open to mergers and acquisition can still merge. But the way it's been structured on a tier base is to ensure that any insurance company who is not even open to a so-called M&A can still remain in business, only that they will take on limited risk, I mean, from the tier base, if you're life, for example, the minimum at the tier 3 level is about 2 billion. That's if you're on a tier 3. On a tier 2, you can have a minimum capital base of 3 billion. And then if you are tier 1, your capital base should be about 6 billion. So on that level, so any insurance company that wants to focus only on life, for example, will have a minimum of 2 billion, and then you can maintain a tier 3 base.
Now, this tier base mechanism or system, is it really the right way to go? I mean, when you look at the banking sector, Professor Soludo was tough and decisive on that.
Absolutely.
Now, when you talk about tier base, how does NICOM intend to achieve success?
I mean,
100% success.
So, I mean, the banking sector, it's a good way to draw that comparison. Before 2005, when the banks were asked to maintain that minimum capitalization of 25 billion, the banks were coming from a minimum of 2 billion. And then we had about over 89 banks. I think about 89 banks to be precise. But after the recapitalization, I mean, you saw that regulation opened the wave of mergers and acquisition, and brought about some of the greatest banks that we can see. I mean, it was post-recapitalization that we saw most of the banks even breaking new frontiers and, having subsidiaries outside of Nigeria. Today, we have bigger banks. The combination of all the banks and their capacity, far back as then. I mean, if you put about 5 banks, the top 5 banks in Nigeria together as at then, they're not even up to, one of the minimum banks in a country like even Malaysia, even as far back as then. But after the recapitalization, what was, and it was a quantum leap. You saw from 2 billion to 25 billion. It was not easy. There were some banks that had to merge up to 4, 5. I mean, in some cases, we had up to 10 banks coming together to form one just to meet the minimum. And the essence of this is not just to have minuscule, institutions that cannot really shoulder big-ticket transactions. And in the case of the insurance companies, I mean, we're looking at the statistics, and we talk about insurance penetration. That's when you look at the gross premium written over the GDP of the country. Indeed, the country's GDP should tell of the amount of the capacity that is available, to underwrite insurance risk, so to speak. And in this case, we are seeing a situation where Nigeria's penetration rate is about 0.3%. Meanwhile, a country like South Africa, is as high as 16%. Even Kenya, it's about 2.6% or thereabout.
No.
Now, if we must have let's say Nigeria even wants to get to the level of Kenya in terms of, insurance penetration, it will mean that we have to more than quadruple whatever, level that we are currently. Surely if we are going to grow that sector, there needs to be a lot of much more recapitalization in order to help to underwrite more transactions, and that will take the sector to the next level.
So the recapitalization, whatever, is quite critical at this point. Now, the NSE says it's offering the sector a special window, in light of a recapitalization, mainly for listed underwriters. What do you think Mr. Onyema implies, with that special window?
Well, I mean, I would think that, the capital market is there, and indeed, most of the insurance companies are listed on the Nigerian Stock Exchange, and to that extent, they should have access to the capital market for them to be able to, raise capital for those who are willing to be on the tier 1 base. For the insurance business, you're either into life, non-life, or you have composite license, in which case you can be in life and non-life at the same time. And all of these require, based on the tier-based recapitalization, it requires more capital, for you to be able to, hold and operate at these levels. Now, what the NSA is suggesting is that currently most of the insurance companies are listed, even though their activities are not, in terms of activities going on the exchange, we don't see most of the insurance companies contributing, mostly. And again, this is because of the state in which they are, talk about their fundamentals in the real sense of it, because the starting point is the amount of risk you are able to underwrite, So if you are not penetrating the market as much as we can, what you then see is that the activities will be sort of limited, in terms of return that they generate for shareholders, it also becomes limited. So, but with this new recapitalization, they are able to, raise more capital. So I think what the NSA is suggesting is that the capital market window is available for most of the insurance companies, of course, who are also listed, to be able to take advantage of. But of course, the general market mood now is depressed. The window the insurance companies have now is till June 2020 for them to be able to recapitalize, and that's about 6 months from now. We think that most of them will be able to find a way around it. But those, the only thing I do not foresee for now is mergers and acquisition, because the way the regulation has been set out, it allows you to stay on your lane if you really do not want to combine businesses with other, unlike what happened in the banks, So most of the banks, even NICOM has the intention not to take any insurance company out of business. So if you want to stay on your lane, you can actually
Robert,
be on your
just
lane.
a quick one before I let you go. How much do you think can the insurance firms achieve, with primary market, activities, especially at a time when the system seems to be challenged?
Well, in terms of primary market activities, that's approaching the capital markets, possibly to raise capital. There's a little bit of challenge because the entire market sentiment is generally low. And to that extent, and given where the insurance story and where they are coming from, most investors may not be particularly disposed, to insurance companies, coming through rights. And I think what most insurance companies are trying to do is looking inward and seeking alternative means of meeting these capital requirements.
All right, let's just hope they end up meeting this capital obligation. Thank you, Robert.
Thank you for having me.
That's Robert Omotunde, an investment analyst. And with that, we draw the curtain on today's edition of the program. Thank you for watching. I'm Chimeze Obi Iwago.